Good afternoon, and welcome to the Estate Planning Council's program on changes to estate planning part 2, taxes and recent legislation. Hopefully many of you saw part 1 earlier in May regarding the healthcare proxy changes. And now we want to bring you up to date on the changes in taxes and some of the recent legislation coming up. I wanted to remind everyone about the membership requirements for the Estate Planning Council. All members are required to attend at least 2 meetings during the fiscal year from September 2021 to June of 2022. Also, the dues notices went out electronically on August 24th. Thank you to all of you who have paid your dues. If you haven't paid it yet, hopefully you will soon. And if you haven't received the notice, please let the office know as soon as possible. Also wanted to thank all of our 2021 sponsors. They've been on the screen. But I just want to mention the 5 platinum sponsors that we do have right now at this point in time. First is Canandaigua National Bank and Trust Company, Wealth Management, ESL Trust Services, LLC, Finger Lakes Financial Services, Inc., Welker, Mosev, and Delvecchio, and Woods, Oviatt, Gilman, LLP. The 5 platinum sponsorships were sold out for 2021. But if your company wants to be a gold sponsor or a silver sponsor, those are still open. And please contact our communications committee chair, Vicki Kleehammer at the EFPR group. Solicitation of our platinum sponsors will begin for calendar year 22 in October. So keep that in mind if you want your firm to be a platinum sponsor for next year. Please know that the speaker evaluation form will pop up on your screen when the webinar ends. Please do not leave early. Also, there's a link for networking that will be in the chat, and it was also sent to the original confirmation. For those of you that want to stay for networking, there's the opportunity to do so, similar to what we did back in April when we had the networking reception through the Rome Cafe. I just want to remind all the attorneys that need CLE credit to enter the code numbers on the speaker evaluation form in order to earn the CLE credit. Our speakers are going to announce the codes during the presentation. There'll be 2 codes throughout, so pay attention to those. Also, attorneys must turn in the CLE board's revised attorney affirmation form, which is currently available on the EPC website, epcrochester.org. Now I'd like to introduce Craig Gingrich for chairing this meeting and coordinating this meeting. Craig is with Sage Ruddy & Company, and he's been a member of the Estate Planning Council for a number of years. I'll leave it open to Craig to introduce our speakers.
Awesome, thanks, Don. I have the pleasure of introducing our 2 tremendous speakers and brilliant minds who have graciously volunteered to share with us today. It's sometimes a thankless job as we've been prepping this, but I'm very excited, and I hope you guys will all enjoy as much as I've enjoyed watching them go back and forth and talking about some of the proposals and very interesting stuff. I'm going to start with introducing John, who I hope is getting CE out of this because it looks like he has 6 or 7 organizations he probably owes CE to. John Owens is a lead planner and a certified financial planner, enrolled agent, equity compensation associate, and a certified private wealth advisor. Impressive. Focused on helping individuals and families navigate significant life changes. He's at Brooklyn FI, which is a very cool firm. If you have a moment to hop onto their website, the work that they do is fantastic. They're a fee-only financial planning, investment management, and tax firm in Brooklyn, focused on planning for equity compensation, concentrated stock positions, and taxes for professionals and creatives. John, we're very excited to have you share with us today. The second half of this dynamic duo is Tim Muck. So Timothy Muck, he's a partner over at Barclay Damon, LLP, primarily concentrates his practice in developing estate planning, tax, and business succession strategies to help achieve clients' personal and business objectives. Tim provides advice for a diverse array of clients ranging from business owners with complex estate planning needs involving strategies to minimize taxes, often using trusts and other estate planning techniques, to individuals on marital agreements. So if you see him, he's a brave man that he wants to venture in the world of prenuptials and postnuptials. Better you than I. That's a dangerous world. But important work in protecting assets from the cost, protecting assets and also helping protect assets for long-term care. He actively works with clients to accomplish their objectives while also addressing the emotional, legal, tax, and technical considerations. He does a lot. Extensive experience counseling business owners as part of business succession planning, transitioning ownership among family members, negotiating exit strategies. He basically does it all. Very impressive. Thank you both, John and Tim, for sharing with us today. Very excited to hear your thoughts on what's already happened and how we can utilize some of those strategies. And then if you can peer into the future, into your crystal balls, and tell us what the heck Congress is going to do, that's bonus points. So I'll let you take it from here. Thanks again for being part of this.
Thanks, Craig. Thanks, Don. We're excited to dive in here today. Now, can everybody see my screen? Let's get the easy stuff out of the way here. Are we all good? Good. Thanks for the thumbs up, Craig. So Tim and I are going to tag team this one today. This one's a mouthful, but changes to estate planning part 2, taxes and recent legislation is the name of our presentation. I'm John. That's Tim. And let's just dive right in because there's a lot to talk about. And so to kind of highlight our agenda for today's talk, we're going to talk about the legislative landscape and do an overview because I feel like it's been drinking from a fire hose the last couple of years. Tax Cuts and Jobs Act, then we had Secure Act, then we had all the coronavirus provisions. Now we've got 2 big pieces of legislation hanging out there right now with the bipartisan infrastructure deal, and then whatever's going to happen with budget reconciliation in the next few months. And so we have this rapidly changing tax landscape, this rapidly changing planning landscape. And so we're still digesting. I think there's still guidance coming out from many of these different changes that have come into play in the last couple of years, and yet there's going to be more changes. And so we need to be mindful of that as we're planning for our clients. We're then going to talk about the pending changes to both estate planning and income tax planning. Take a look at those. We're going to look at some of the strategies for estate planning. Tim's going to touch base on some of the estate planning strategies that are out there and how we navigate that, both in 2021 under the current laws and potentially in the future if there are changes. I'll touch base on some income tax planning strategies as well, if we're thinking there's going to be changes there and how we should evaluate that. And then, we just had Labor Day weekend. It is year-end planning season already. That's what we're feeling at our firms. I'm sure many of you are feeling that way as well. And since it's year-end planning time, we decided to put together a checklist for how can we evaluate the decisions we need to make here at year-end. How do we help our clients? And then, of course, we'll have time for questions and answers. And so that's our agenda. That's where we're headed here. And so I'll kick it off with the influx of legislation here and start off with the Tax Cuts and Jobs Act. This feels new, but it really isn't new. We're almost 4 years away from when that was passed. And so, it's kind of old. It's actually getting close to the expiration before you know it, it'll be into 2025 when many of the provisions of the Tax Cuts and Jobs Act expire, but lower ordinary income tax rates for folks, lower rates for small business owners, and there's lots of plannings around that. We need to be mindful of that as we're planning. Tim, why don't you talk a little bit about some of the other 2 changes that we've had in recent years with the Secure Act and some of the coronavirus provisions?
Sure, thanks, John. So the Secure Act, in my opinion, I think is really for especially for us planners, was a huge change. And I think a lot of us are still sort of digesting it and frankly waiting for some more guidance on some of the provisions that came out of it. I mean, the largest changes, as most of you should know, is that we've added sort of a new classification, if you will. We now have this concept of what we call an eligible designated beneficiary. So in the past, we used to have a designated beneficiary, and the advantage of that status was you could take distributions out from an inherited retirement plan over your life expectancy, which was a great way to sort of dribble out money over time, not have to pay a lump sum of tax on that money in that retirement plan. So Secure added sort of a harsher classification now, this eligible designated beneficiary, and limited it to only certain groups. So spouses, minor children, disabled account owners, chronically ill individuals. So those are the ones now that qualify for this lifetime stretch treatment. Everybody else has been essentially dumped, if you will, into this term that now says you have to withdraw the balance of the retirement fund by December 31st, at 10 years following the year of death of the participant. So what it's done obviously is compressed and sped up for a lot of people what will ultimately have to come out of those retirement plans and pay tax on. So cynically, in my opinion, I think it's kind of a revenue grab that affects people who may not even be born yet, frankly. And just they're not voters, so of course we can stick it to them. It's not going to hurt them any. But at the same time, I guess the trade-off is hopefully many of you know the age for starting to take RMDs has gone from 70 and a half to 72. So we've gotten that. One other just point on Secure that I think bears noting, because a lot of people will say, well, that inherited IRA was before 2020, so it doesn't matter. So remember, under Secure now, if you have an inherited IRA that even came on, was inherited, if you will, before 1/1/2020, and your beneficiary then dies, it now falls into Secure, and then that IRA has to be distributed by December 31st of year 10 after the year of death. So you don't have the option, as you did under the old plan, to take it over the balance of the life expectancy and stretch it out. So really, from a planning perspective, I counsel my clients all the time. We have to look at the beneficiary designations. We have to make sure if we are leaving assets in trust that we either qualify them for younger children, either an accumulation or a conduit trust, so that we can still get that lifetime stretch. And for spouses, a lot of it is still sort of the same. The only thing we've sort of lost, if you will, is that second bite at the apple. That ability for the surviving spouse to then roll that IRA over into their own and then name their children as beneficiaries and have the children take it out. But the flip side of that is it's really now made it where if we leave an IRA to like a marital trust, a Q-tip trust, and we meet all the requirements, it's essentially the same thing as if it had gone to the spouse from a pure timing perspective. So that's Secure. CARES, at this point, the most of the changes from CARES really affect 2020. So unless anyone has a time machine or has clients that for some reason, and I don't know why, want to go back to the year 2020, a lot of this stuff is already sailed. But one of the changes, which not a huge change, but we do have now this $300 above the line deduction for charitable contributions. The limitations on charitable contributions, so the AGI limits have also been adjusted. And in the case of the normal 60% limitation has been removed completely. So that is new and that's staying. Some of the stuff from 2020, again, that's no longer there, was we had the RMD requirements for 2020 were waived. So a lot of our clients didn't need or didn't want to take an RMD, so they didn't have to. There was also this concept of the COVID-related distribution. So if you had a coronavirus-related distribution, you can take an early distribution from your retirement plan, wouldn't be subject to the 10% excise tax. And then for businesses, there were a lot of changes. Some of the NOL rules that had changed, the Tax Cut and Jobs Act, were then sort of tweaked back to give back some of the things that the Tax Cut and Jobs Act took away. One other change, which wasn't statutory, but again, for us in the estate planning community, that I think just everybody should be aware of, because some people just weren't aware of it, frankly, is that at least as of now, we can sign electronically, or clients can sign electronically, estate and gift tax returns, which has been sort of a real boon, especially, frankly, on the gift tax returns. For some reason, I have clients that have a hard time understanding the spousal consent to split the gift, and both have to sign the return. But DocuSign has been a godsend, because I can just email it to them, have them click and sign, and they're done. So that's kind of in a nutshell, the Secure Act and CARES. John, I don't know if you have anything else to add on top of that, which was probably already too much.
No, I think great job, Tim. Great job on uncovering those two big pieces of legislation. Secure Act having those longer term impacts, CARES Act having kind of those shorter term impacts in that land. And so I kind of put this green line here on the presentation, because those are all law, things that aren't law yet, but are kind of working their way through. We've got the Infrastructure Investment and Jobs Act. So that is the bipartisan infrastructure framework. They're calling it the BIF for a little bit. That's still out there. That's sitting in the House. There might be voting on that soon. Not a lot in terms of revenue raisers in there, but there is a focus on cryptocurrency tax reporting, improved reporting on cryptocurrency transactions, with the focus on closing the tax gap. So keep an eye out on that. Lots more folks are getting involved in crypto. Not going to go down that road in terms of my opinion on whether they should be doing that, but nonetheless, it is a focus for the enforcement folks at the IRS. And then we've got budget reconciliation, which is the other big thing. We're looking at $3 to $4 trillion potentially in spending here over the next 10 years. I think the Democrats are going to try to push something through. That's where we're definitely going to see the revenue raisers. And so a lot of my focus today is going to be talking about what are some of those revenue raisers based on what we've seen, and then what are the planning strategies going to be if these come into fruition. What's the low-hanging fruit that even if this doesn't pass, or only if a version of this passes, what are the moves that make sense for our clients to think about today that have little downside, especially as we get close to year end? And so let's take an overview of some of the changes that are in the works out there. And let's start out with estate taxes. And this is a little misleading in terms of a title, calling it estate tax changes, because it's really income tax changes, or the way we recognize income. And so obviously, currently we have a step-up basis at death. That's been the case, Tim, for ever, basically, because who wants to keep track of it? I know people who bought stock in the 1980s and still have no clue what the basis is. Imagine if you bought it, 80 years before that, or it's an old family business. Well, one of the focuses of the Biden administration and the proposals they put out is making death a realization event. What they've effectively proposed is looking at a $1 million unrealized gain exemption per person, and keeping the $500,000 primary residence exclusion for couples, $250,000 for single folks. And so effectively, married couples would have this $2.5 million unrealized gain exemption. So when you think about this, 98% of the American population unaffected. I mean, where do people have their wealth? They have their wealth in their homes, most people, or in their retirement accounts. Retirement accounts are, ordinary income assets. There's no such thing as unrealized gains. We don't have to worry about that. So, it's really going to be our clients that are affected by this. But what's interesting, and Tim, you and I talked a little bit about this as we were preparing for this conversation, is that none of this is focused right now on going after the exemption and lowering the 11.8 million or so exemption at all.
Yeah, exactly, John. And it's interesting because one of the articles I read said that when the American Families Plan was originally proposed, they had the $3.5 million exemption, which is sort of the dirty little secret, if you will, that they don't want to come out and say they support. But when you look and listen, that's what they're supporting. Mm-hmm. And allegedly, it was removed at the last moment right before they presented the plan because for some reason they didn't think that they would get enough support to push it through. So it is that it's sort of nibbling around the edges. I think the other sort of intriguing thing about this is that the idea that this tax, this capital gains tax, if you will, on the realization here, will actually serve as a credit against the estate tax based on, again, what they're proposing. So
it's like an IRD type situation, basically, so you don't get hit twice.
Exactly.
So very interesting change. And obviously, as we talk about strategies here in a couple of slides, it really might turn upside down the way we think about estate planning. Because right now, so often, I mean, and I see it from the investment management side, from the planning side, hey, these are assets I'm going to hold on to for the step up. I'm going to hold on to these for my kids later on. If that step up isn't going to happen, does that change, the way people think about different types of assets and how we use them? And so those are some of the estate tax changes. Oh, go ahead.
If I could just one other interesting point on this. So, John, probably not for you, but for some of us in the Western area, we have a lot of clients that have a lot of times property in Canada, and this frankly is very similar to the Canadian system, which treats death basically as a realization event. But two other realization events that were in at least the Biden Green Book proposal, which was to also include a gift of appreciated property as a realization event. So again, you transfer your appreciated stock to a child, you're recognizing that gain on that. And then also certain distributions from trusts, which this one is really fascinating because the Green Book, the idea was that there would be what they call a recognition event at least every 90 years. And they would start that running from January 1 of 1940, meaning that if there had been no recognition event by this property in the trust as of December 31, 2030, so a little over 9 years from now, they would recognize all the assets in that trust, or the unrecognized assets in that trust, if they were sold and realized. So, very fascinating, very interesting, and it's going to really, it would radically change planning, obviously, for all of us.
And, if you know anything about the budget reconciliation process, one of the things is they look at revenue neutrality over 10 years. It's funny how that 90-year window starts in 1940, such that there'll be a recognition event before the end of the 10-year window for the reconciliation. So I'm sure that was chosen on purpose.
Right. One other point too, just real briefly, is that the other thing that I found fascinating, because I do a lot of work with closely held businesses. So for us, the concept of discounts for lack of marketability, minority interests are, sort of expected and routine. But on these deemed sale events, they made a point of saying that any partial interest would be valued essentially at its what they call proportional fair market value. So think of your business that has a value of $1 million, and if you have a 20% ownership interest, I believe what they're trying to say is that's $200,000 for purposes of this deemed recognition event. Whereas we would normally say, well, we could discount that maybe by 25, 30, even 40% and bring that out. So it's sort of a backdoor way to get on these concepts of marketability that have been, sort of embedded in the system for years.
Absolutely. Thinking about the income tax side of things now, and so they're coming. On one hand, we're thinking about assets. We're thinking about the potential for taxing death, making death a realization event. On the other hand, while you're alive, while you're around, there is a big focus on increasing income tax rates, especially for high earners. And so a big part of the proposal is taking the top bracket back up to 39.6%, which is what it was back in 2017. So from 37 to 39.6. Keep in mind, I think a lot of people see this and they think, well, that's a big change. That's a big tax hike. Keep in mind, they're not talking about raising any of the lower brackets. They're not talking about making it go from 12 to 15, from 22 to 25, from 24 to 28. So effectively, if you are in one of the top tax brackets, if you're in the 37% bracket, your taxes will still be lower than they were in 2017. They'll just be higher than they were in 2019 and 2020, all else being equal. Not offering a political opinion there, but just something, relatively speaking, where they're just talking about bumping up the highest bracket. And so it is going to affect our high earning ordinary income clients. But the bigger change, the bigger impact item is talk of increasing the top capital gains bracket to 39.6%, which would be a very huge change for our clients, especially our clients that have businesses, especially our clients that have significant, wealth in their brokerage accounts and in stock. And effectively, pairing up that with the ordinary income tax brackets. And they've talked about doing this at about $1 million. They say that's kind of the income threshold we've been hearing for this higher capital gains bracket. And it would be a big change. So there's a lot of ways we would plan around that and change up the way we think about capital gains situation and strategy there. And, I think this is the one, Tim, that probably scares people the most, especially if you're 58 years old, you're thinking about retiring, selling the family business or something like that. This can really, that could be potentially a 20% difference in what you take out of the business here.
Yeah, exactly. So now your job is to basically increase your client's return by 40%, essentially, make up for that tax. So it makes your job a lot more difficult. Absolutely. So it's a tricky thing there. The other income tax focus changes, they're looking at improved reporting on crypto transactions, as I've talked about before, and just a big uptick in enforcement. They want to focus on enforcement and closing the tax gap. There's been a lot of focus on that. I've seen several articles just in the last week from Commissioner Reddig of the IRS about how do we close the tax gap in the United States and how do we collect more of the revenue. It sounds like for every dollar you give the IRS, they get a very significant multiple back. But I think the practical impact of this is, hey, we're professionals. I'm an enrolled agent. We've got attorneys here, accountants. We deal with the IRS. We represent our clients. We help our clients when they get those letters. And we all work with the type of clients that are going to be getting more letters, that are going to be getting more inquiries, that are going to be subject to further scrutiny. I know all of you are above board. You're all doing the right things for your clients. You're not taking any, overly aggressive strategies or anything like that. I have confidence in that. But nonetheless, there's going to be that scrutiny. We actually need to prepare our clients for the fact that there's going to be, that printer's going to be working even more at the IRS. And shipping out more letters and questioning more things if this goes through. And it's going to just take up more and more of our time. It's going to cost our clients money, even if they are not, even if they are being compliant, because there's just going to be so much more scrutiny as part of this. So, John, we just have a question. Sure. does the proposed top capital gains bracket also preserve the lower existing 0 to 20% thresholds? Which I believe the answer is yes, but
Yes, that's my understanding, that it does preserve the existing 0 to 20% cap gain thresholds, and that's one of the planning strategies we will talk about here as we go to the next section. And so we now have our first CLE code. So the first CLE code is 7421. I'll leave it up on the screen here for a couple of seconds so everybody can get it, but we will not return to this slide. So this first CLE code 7421.
John, while we have the code up, I just wanted to actually go back to 1.2 on the whole change, if you will, to the up and carryover basis regime. So I don't know if you saw, there was an interesting article in the New York Times a couple of days ago that talked about the lobbyists sort of descending on this tax bill and actually sort of putting together a list of what they think is going to get ripped out, what they're going to get away, I shouldn't say get away with, but what they're going to be able to have removed and what's going to stay in. And based on what that article says, they're pretty much giving up on like the 39.6 tax bracket. They're not going to fighting that, but they are going to make a stand on the whole carryover and step up basis change to the regime. So hopefully for all of us, that makes life a little bit easier. But at the end of the day, I think we have to realize, politically speaking, it's going to be very difficult because the Democrats can only essentially act as far as their most conservative member is willing to go in the Senate. And so whoever, thinks that's a bridge too far basically has veto authority over essentially the whole thing.
Yeah, and it's going to be very interesting. I mean, the Democrats want to be big, they want to be bold. I think there's a decent chance that they only have total control for 2 years. And so they need to, they're going to get done what they get done, and they probably have to do it pretty quick. And so it'll be interesting to get across the finish line. Michelle asks, any talk about capping the deductibility of 401k contributions? I haven't seen too much. There was a Biden proposal during the campaign to change the way you get a tax benefit, basically levelize the benefit for 401k contributions, and keep it more along the line that you get a credit of like 25% of what you put in, so that if you're a low earner in the 10% tax and a 10% bracket, that you actually get a bonus for putting in a 401k, but if you're a high earner, you don't. I haven't seen anything else on that. It seems like it'd be a big shift in the system, but I haven't heard much other talk on that, Michelle. I don't know if you have, Tim.
No, yeah, nothing on my end.
So let's talk a little bit about strategies and how to approach this. And so I think there is one very obvious strategy for folks that don't want to deal with this. And if you are immortal, if any of your clients are immortal, have those powers that they can live forever, they don't need to worry about this. They don't need to worry about the step up going away. They don't need to worry about estate planning in general. But for anybody else that is going to die at some point, they should be worried about this. They should be planning proactively. They should be talking to folks like you all. And so like to always squeeze in a little meme break in here. And so I'm going to turn it over to Tim to talk about some of the estate planning strategies and what we should be thinking about for 2021 and beyond if some of this comes into fruition.
So for 2021, in a lot of ways, frankly, it's probably grabbing your clients, your wealthier clients, and screaming to them, if you're going to do it, you need to do it now, right? There's nothing all of us in the planning community hate more than the titular client that will call you up on December 15th and say, I want to give away $11.7 million and I want to do it by December 31st. And oh, by the way, here's 50 different things that we need to get done between now and then. So we are trying to encourage our clients that have been thinking about it to really act sooner than later. Again, going back to the potential change in law, at this point, I'm not aware of any sort of retroactive application. It sounds like any change that would happen would start as of January 1, 2022. So thankfully, if that's the case, we would at least have until the end of the year. But John's, I think the first point on John's slide is really prescient, right? You got to look at not just the assets, but then the basis in those assets and what you have, how long you've held them, and what is going to make the most sense from a gifting perspective. And this is where, skipping down to the third one, if we look at gifting to intentionally defective grantor trusts, right? So we have that trust that the grantor still pays the income tax on, but we've got that asset out of the grantor's estate, or the appreciation in income, if you will, out of the grantor's estate. remember, we almost always have that swap power that's going to give us the grantor trust status. And I think that's something that we as planners sometimes overlook, is the ability to utilize that swap power and exchange asset bases. So again, if we're still next year in a stepped up basis environment, right, and we have our client that has assets that have maybe cash or something where we don't have much gain there, we can take that at cash, put it into the grantor trust, swap out the closely held business interest, for example, that may have all gain, and then our client, holds on to it, and then when they pass away, we get that stepped up basis. So there's a lot of power there. Now, the caveats with that are same as they always are, which is you have to be careful on the valuation if you're going to utilize that swap power. Obviously, if you're swapping cash for a marketable security, that's going to be pretty straightforward and easy to value. But where we have the closely held business, we have the real estate. We got to spend time. We got to get good valuations by good appraisers. I know I'm probably preaching to the choir here, but it just can't be said enough. So that's the first thing on the strategy, at least for this year. So using up the lifetime exclusion. So again, there's options for this. The defective grantor trust is a great way to use up the lifetime exclusion. If you do have clients that are married and want to have some ability to, potentially benefit one way or another, so the spousal lifetime access trust, or SLAT, is a great planning strategy there that we can use. Some clients don't want to make a decision now. They want to sort of punt and put stuff in and have the ability to make the decision later. So with those types of clients, we've talked to them about doing the lifetime Q-tip trust, right? Where spouse one puts assets into trust for spouse two, and we can elect whether or not to make the Q-tip election. So if the exemptions were to go down next year and we wanted to use up the exemption from 2021, we just wouldn't make the Q-tip election. And so therefore we would be using up a good chunk of that spouse's lifetime exemption. Let's say everything stays the same and nothing changes, and we don't necessarily want to use the exemption up. Now we can Q-tip it, so we qualify for the marital deduction, so there is no taxable transfer. So the beauty of that is we have the option to make that transfer this year, but the Q-tip election isn't due until the gift tax return, which would normally be April 15th, 2022. Or if we extend it, we have all the way till October 15th. So we can buy ourselves time to wait and see what happens on the legislative side and figure out what we want to do. So, we always love having the flexibility to do something now and make the decision later when we have better information. Just one other point then on the beyond 2020, 2022 and beyond, and again, I think John hits the nail right on the head with this slide here, which is, looking at sort of tax arbitrage and looking at the ability to transfer or exchange, if you will, tax rates. And so here, for example, a trust that hasn't been used in the past a lot, but I think it's becoming more popular, what we call the BDOT, or the Beneficiary Deemed Owner Trust, where we have, the beneficiary of the trust has a withdrawal right to take the income from the trust. Therefore, all the income generated by that trust is taxed back to the beneficiary. So why do we care about that? Well, anybody who knows the difference between individual and trust income tax rates knows that trust rates are basically compressed, right? Your top tax rate for a trust, the 37% right now, starts at just under $13,000, let's say. So once you hit your top rate, you're getting taxed at that top rate, plus you're going to have the surtax and the higher capital gains rate. Now, if we have that income being taxed back to a beneficiary, we can use up their lower brackets and their rates and benefit that way without having, again, pay the higher tax rate. So that tax arbitrage is a strategy I think that's going to be in place, and probably, again, depending on what changes come to the system, will be even more utilized in the future.
Yeah, and Tim, I think one of the things we need to be thinking about is, especially for some of these high earning clients that that have a decent amount of income, but maybe they're $500,000-$600,000 in income. If these come into place, and we're looking at a realization event at death and all that, we might want to look at filling up that 20% capital gains bracket each year and pushing your income up to $1 million. Every year we push our income up to $1 million. We proactively harvest capital gains. I know we spend so much time, tax loss harvesting, looking at all that. This is we might have to do the opposite, because you recognize that if somebody has millions of dollars in unrealized gains, that it's going to be a long time until you can recognize all that. So you might be really happy to pay tax at 20% illusory. It's 23.8% effectively on those gains. but doing that every year, if we end up in this environment, and that'll minimize the hit to your heirs, and that'll help you out along the way.
Yeah, that's great. Good point, John. The only other point too is, there are potentially, we have some clients that would have installment sales, for example, and I have heard some people talk about sort of, if the law does change, electing out of installment sale to recognize the balance of the gain before the rate goes up. But look, I'm not a economist, but I do know paying tax now, if we're saving, depending on what the rate is, it may not make sense, right, to basically front load that tax and pay it now just to save a little bit of tax over the time value of money, if you will. So just something, again, that I've sort of heard of anecdotally, but frankly, I haven't seen a lot of, and probably won't unless there is some massive change in the law at this point.
Tim, what do you think about charitable trusts and how they come into this landscape of, death as a realization event and all that? You think we're going to see a lot of CRTs being used to kind of work around this? Basically, put your low basis assets in a CRT to avoid the tax on the gain, and then kick out the ordinary income to the heirs for 20 years?
Potentially, yeah. I think this was also sort of discussed as sort of a, if you will, a poor man's workaround for some of the
stretch,
right? To try to get stretch, if you will, on an IRA, is to have it go into the CRT. I mean, I always look at this, from my perspective, it's don't let the tax tail wag the dog. The first question we always, do you have charitable intent? And if you're just doing this to get the tax benefit, right, you're not going to be better. Your beneficiaries, if you will, aren't going to be better off than just paying the tax anyways. But for the right client, yeah, I think this does make sense. They just have to understand how it works, and that it doesn't mean that the money is going to come out of the trust to them tax free. I've had many clients that seem to think that it means nobody ever pays tax on any distributions from the trust, and I can assure everyone that is not the case. The distributions will be taxable, but in the right situation, a CRT can be a great thing, especially where we have a lot of times where we have clients that want to have, a child, or maybe they're not married, they want to benefit somebody in the form of like an annuity, essentially, and then get a lifetime payment, so they know they're getting something. So again, in the right scenario, it's a great tool.
Absolutely. Let's talk a little bit now about the income tax planning strategies and how we start to think about those in the context of this potentially changing environment. And so thinking about higher tax rates going to 39.6 on ordinary income, potentially 39.6 on capital gains, and what we want to do there. And so I think in 2021, one of the things we want to focus on a little bit is accelerating capital gain income into this year. And so paying tax at 23.8% sounds like a good number. I don't think, Tim, that's going to get any more favorable for folks. That there's going to be I don't see that rate going down for our clients that make $500,000, $700,000 a year. And so there's that. I also think that for our clients in the top bracket, in the 37% bracket, if they're there, and they're always going to be there, then that's still a favorable rate to pay tax at, with one really big caveat. And that is thinking about the geographical arbitrage. And so are they moving from, living in Brooklyn, like where I live right now, to Palm Beach, or to Tampa, or to Austin, Texas, or to Vegas? Are they going somewhere else where that state tax arbitrage and state and local tax arbitrage will be better than whatever happens with the federal rates? And so we need to think about that. But overall, all else being held equal, I think 37%, if you're a really high earner, is a decent rate to pay tax at. And I don't think that's going to get more attractive if your income's going to stay really high. And so that's something to think about in 2021. I think one of the things that's really playing out in the House right now, and there's a bit of a tug of war between, these kind of blue dog Dems from the Northeast in the high tax states, and then we've got some more progressives on one side when it comes to the SALT tax deductions. And so we've got the $10,000 cap. We're seeing some neat strategies there for small businesses. New York actually has this PTEP deduction now, where partnerships can elect to pay the tax and try to write it off. So we're seeing a lot of focus on that. But, for most folks, they're limiting that to $10,000, and that's been a big hit for many of our clients. I think there's a strategy where if you got winter property taxes, if you get your fourth quarter estimate, you want to defer them into 2022. I think that makes sense because I think there's a better chance that the SALT cap goes up a little bit next year. As part of this pending legislation. I don't think it's going to change this year in 2021. And so we might have a more favorable landscape there. Similar thing for charitable donations. Again, not telling anybody what to do when it comes to charity. I think that's a very important thing. And I think, we're lucky we have gracious clients that give money away. But it looks like they will get more bang for their charitable buck next year if rates are higher, if we're in a higher tax rate environment. So just something to think about there. We do a lot of stock options planning here at our firm. So we've got a lot of clients that are employees of early stage startups, companies that are going public. And so we see incentive stock options very frequently. And so one of the big advantages of incentive stock options, you exercise, you hold them for 1 year from exercise, 2 years from grant, and then you get eligible for long-term capital gains treatment. You might have to pay some AMT along the way, depending on what your bargain element is. But if we go to this environment where you're paying 39.6% on capital gains over $1 million, then that can change the way we think about ISOs and ISO strategies. And so I'm not saying we disqualify all ISOs, but we might disqualify a lot more than we currently do and take less risk in terms of exercising holding because the upside will be more limited in an environment where capital gains are taxed at 39.6. Now, if you could get QSBS potentially, if there's other favorable tax treatments out there, then you might not want to go that route. But nonetheless, it is something that we are thinking about watching very closely when we're planning for clients that, who would otherwise be exercising holding for a year. We talk about income. We also got to think about deductions and depreciation. And so, a lot of people 179, a lot of people expense things. We want to think about whether you would be better off depreciating and spreading that out over several years if ordinary rates are going to be higher. And that's more valuable to push that out into future years. Many people want the immediate tax benefit. I don't blame them, but that is something that, our business owners, if you've got a client that's closely held business and they're buying billions of dollars worth of equipment every year, this could matter. This could be really important. I think we got to look at Roth conversions. We've got to look at Roth conversions very closely, especially for our folks in that 37% bracket that are going to be there and stay there. And so if we think rates are going to go up, paying tax for 37 versus 39.6 and doing some conversions this year, I think might be a way to buy some tax insurance effectively. And then we got to think about geography, especially during COVID. I mean, I'm sure you all have clients that are picking up, that are moving, that are all over the country, that have left. We're seeing a ton of residency audits come in for folks, and tons of questions there. That could be a whole other webinar that I shouldn't be the one hosting it, but that's a huge focus. And as we become more virtual, like this event, more geographically neutral, where do people go? Where do they work? What's the state tax impact? And how does that impact the way we strategize from an income tax perspective? Because if you're a software engineer at some New York company and you can go work from Miami all year round and not pay any state and local income taxes, that could make a big difference if you're going through a $5 or $7 million liquidity event. And so we talk about that a lot with folks. And so we want to think about that, what's going to happen with their state and local taxes as opposed to what we think is going to happen with the federal rates, because the federal rates will likely be moving a lot more.
John, could you just talk for a second on the Roth conversions? Because to me, this is always fascinating because when I work with planners, I feel like there's two camps. There's the planners who are sort of militant about converting, and the answer to everything is convert it to a Roth, and then others who just are screaming, we never want to pay tax any sooner than we need to. I'm always fascinated by the thought process that goes into.
Yeah, and I like to think about it like a seesaw. Okay, so if I'm looking at somebody's tax situation and I think we are lower now and we're going to be higher later, then I want to evaluate what makes sense to convert. How do I levelize this out a little bit more and bump up income now to reduce income later? And on the other hand, if it's higher now and going to be lower later, then I want to defer and I don't want to convert. And so, but it's very unique to both. It's really unique to the client's income situation. Because tax rates change, don't get me wrong, but not dramatically. there's just a great article. Michael Kitts has just had a great article about this not too long ago, last week, if anybody follows him. But talking about how the biggest factor is not changes in tax rates, it's changes in people's income, and people's income changes dramatically. And so it's not I'm not a fan of, it's a one size fits all approach. It's very much evaluating this year in the context of all your earning years, the context of your goals, your income, and determining from there, which is a little bit more work for folks like me. But I'd rather do that and evaluate it than kind of go with a one size fits all. So, thinking about beyond 2021 and thinking about income tax planning under this different tax regime, this potential change, as we talked before. Same goes under the estate tax changes. We want to fill up that 20% capital gains bracket for high earners. That would be a really smart move to just pay tax at that rate, especially if we have significant unrealized gains. We want to look out at how we handle ISO strategies for incentive stock options. Charitable gifting might be more valuable then in a higher tax environment. The other thing to think about with charitable gifting is that so many of our clients right now, you got a wealthy client, let's say a couple, they've paid off their mortgage, they've got a SALT cap of $10,000. They're probably taking the standard deduction, especially if they're a senior citizen. They're getting like $30,000 in a standard deduction, so they got to give 20 grand to charity in order to even start to get a benefit. Okay, so in this environment where the SALT cap comes off, potentially, they probably paid $30,000 in state and local taxes, so they're past the standard deduction there, and so the charitable gifting benefit is a lot more valuable in that case in the future tax year, not only because rates are potentially higher, but because they're already itemizing in the first place. And so that is something to think about for our clients going forward who are in that spot. I can't believe I put this on here, a fee-only financial planner, but non-qualified annuities, are something that would want to reconsider in this environment. If ordinary rates and capital gains rates are going to be the same, then for our really high earning clients, we want to shelter that income. And one of the ways we could do that is through non-qualified annuities. There's a product out there from Jefferson National that is kind of it's really a tax deferral vehicle. And so you use something like that, especially just to kind of shelter that cash. And then what's interesting is that the Secure Act didn't touch non-qualified annuities. So there still is a stretch you could do a stretch on a non-qualified annuity, which is pretty neat for somebody who would inherit that. And then obviously non-qualified deferred comp plans. And so, our clients are executives, they're high earners at the company. What are all the different buckets that we could stash away money into? They fill up their 401k, they do a non-qualified deferred comp plan. Tim drafts them a NIM-CRUT, and we defer because guess what? Whatever they pass here in the next couple of years, somebody else is going to come into office. They're going to change it. And there's a chance that rates are lower or change in the future, and there are more planning opportunities. So how do we push off that tax bill a little bit further for high earning clients if the rates go up? Because there will probably be an arbitrage opportunity later on again. Tim, anything to add to some of the income tax items?
No, I think just on the non-qualified deferred comp, the other benefit to doing that, which again for higher earning clients, right, is we front load the payroll tax, which means that they're already going to be maxed out, so they're not going to pay the full 7% hit, which has been nice. We've had several clients this year who have set up these NQDCs, and they know they've got some money that they're going to have to pay for this payroll, but coming out in the future, they're going to save the payroll tax on the future distributions out of the plan. So that's been nice.
Absolutely. And so I think, okay. The one thing we didn't touch on, Tim, was on the last one. I think I jumped ahead. The talking about permanent life insurance and liquidity for folks. That's going to take a renewed focus, I feel like, with this whole tax on unrealized gains.
Yeah, and it's interesting because one of the proposals out there, the Bernie Sanders proposal, which I think is called for the 99.5% Act, talks about if you make contributions to a grant or a trust, that those contributions would then be includable in the taxable estate for the donor. Meaning, if we have a life insurance trust, right, and we're putting money in each year, we would almost have to break out between the portion of the trust that's excluded from the taxable estate and the portion that's included. And it would really, ruin some of the great benefits that we have of using irrevocable life insurance trusts. It's another, back to sort of using the exemptions and funding there. It's probably almost too late now, right? But you could almost see a situation where somebody goes out and buys a single premium policy to an eye with before year end, puts a big chunk of cash in so that they use it up. But again, I think, going through the underwriting and all the necessary steps to do that, it may be a little bit late in the year to try to accomplish that. Absolutely.
And I think, the focus is on, I had somebody recently exploring an islet, but all of their investments were in marketable securities. And I kind of talked to them about, like, you don't own a family business. We don't really need this necessarily unless you want wealth replacement. But you don't necessarily need liquidity to pay the tax. You're probably going to be fine. And so it's just understanding our clients' goals and what's important to them when we're setting up stuff like this.
Yeah. Sort of the unfortunate truth of, especially working with a lot of business owners, that the people who need the life insurance most are the ones who hate it the most. So
yeah,
it's an entrepreneur that they need to go out and buy, $2 million of guaranteed coverage can be, one of the most difficult things I think that there has to do.
Absolutely. And so just to kind of wrap things up and tie it all together, I think in terms of 2021, as we're approaching year end, as we're thinking about this, what I would call fluid legislative environment, like who knows if they're going to get anything done. I don't have a ton of faith in Washington. You shouldn't either. We need to think about our impacted clients. We need to think about who do we need to be worried about. So they have unrealized gains. They're in the top income tax bracket or the top capital gains bracket. These are the three sets of people that are going to be impacted the most. And it's probably most of our clients that fall into one or more of these categories. We want to reevaluate their goals. Is it most important to transfer wealth, to maintain control, to maximize charity, to minimize taxes, to pay tax now, to pay tax later? You're probably going to say all of them. But understanding what's truly important to your client so that you can help them make important decisions. And so I always try to say, I often get emails about, this thing is changing. I'm worried about it. And I'm like, well, tell me what your goal is. Tell me what's important to you. And I'll let you know if you should be worried about it or not. Because just because something's changed doesn't necessarily mean it's a good or a bad thing for you. We just need to look at the practical impact. I think we got to look at what are the actions that have minimal downside, because I anticipate that any legislation that comes through is going to come through like Christmas Eve or something like that. We're probably going to get a continuing resolution to keep the government funded. They're going to kick the can down the road. And then, it'll be like Christmas Eve. They'll pass something. We'll all be drinking eggnog or something. And there won't be much time to implement strategies. And so what are the actions that clients can take in this period of uncertainty? Paying capital gains at 23.8 sounds great. Doing Roth conversion 37% if you're going to be there sounds great. Deferring charitable gifts, accelerating lifetime gifts. I think they are all really easy, simple things to do that have minimal downside for our clients. And so I think those are some of the ideas. I think there are several others out there that we can think about. Develop your action plan if this does become law. Are there strategies you have in place? Documents that are unsigned that you can sign and notarize on December 27th if you need to implement a strategy. And then I think implement the plan. This is a reminder, like this is the Super Bowl for us as planners, as attorneys, as accountants, as insurance professionals, everybody that's on this call. Like our clients need us when stuff like this happens. We've got them through Tax Cuts and Jobs Act. We've got them through Secure. We've got them through COVID. We will get them through this and all the other stuff that Congress throws our way. Let's help our clients. Let's work together. Let's collaborate every way that we can. And most importantly, here is the second CLE code, 6859. That's 6859. And would love to take any questions that folks have. You could drop them in the question answer box here, and Tim and I will do our best to answer them in the time that we have left.
What's mentioned about collaboration, it just can't be said enough how important it is for all the advisors to get together and collaborate and discuss and not sort of try to be the alpha dog in every scenario or situation, right? That's, having a good discussion. I mean, a lot of times we will have discussions without the client so that we can try to remove some of the egos and not try to see who's going to come up with the best idea. and it seems to work better. But I can tell you, I've had situations where people come with ideas. I had a situation several years ago where December 23rd, an advisor comes up with a brilliant idea for a client to do a CRT and donate property into it. And come to find out the property is subject to a mortgage. And so there's issues if we put appreciate property subject to a mortgage into a CRT. The advisor didn't know that, but got the client going down that far on the path that difficult to say, well, no, we can't do this unless you're willing to pay a good chunk of tax on this transfer.
Absolutely. Absolutely. Looks like we got a question coming in here. And so how would you apply these strategies to younger, high earning, high asset clients that will not need to use any investable assets for many years and many different administrations? Yeah, that's a great question. So yeah, I mean, this is my typical client. You know, the typical clients we work with are in their late 20s, early 30s, going through liquidity events, high earners, a lot of assets relative to their age. And so we really try to, what's interesting about the situations that Alan submitted this question, and, you know, what's interesting about the situations I come into is, like, I'll talk to folks like, what are your goals? And you know, when you talk to somebody that's 32 years old, that, you know, it's a software engineer that, like, you know, bought a lottery ticket, basically got a lottery ticket that paid off, you know, they don't sit down and tell you about the family foundation that they want to set up and the, you know, the generational wealth that they're trying to build. They kind of say, like, I like my job. I don't know. I can't believe this happened. And I'm not sure. And so what you really want to do is say, okay, let's look at all the efficiencies we can build now. And so for these younger clients, for these high earner clients, it's really, you know, so one of the things we often look at is, obviously, are they maxing out their 401k? Most of them are. Next thing we look at is something, a lot of these, you know, companies that younger folks work for have something called a mega backdoor Roth. It's after-tax 401k contribution. You basically defer another $38,500 a year on a tax-free basis. And so that compounding effect for them, you know, basically getting 6 times what a normal person could put in a Roth, is really helpful. Obviously, if you're talking high assets, high earnings, that's still a small piece, but it helps, especially if they're going to do $38,000 a year for the next 10 years, and it's going to compound over the next 40. So we look at stuff like that. Then we look at just building diversified wealth for them, and building efficiencies for the future. But, you know, when you're not going to use this money for many years and many administrations, it's this tricky balance of, like, you're not going to give it all away today. And we're not especially focused about getting appreciation out of the estate. And it's weird because I think a lot of the folks that I see in this are in, like, the 1 to 5 million in assets range, which is a great place to be in your early 30s. Don't get me wrong, but it's not like you're at $40 million, and so you can give away 10 and still be fine. And so it's a tricky situation, but I think oftentimes what we need to do, Alan, is look at how do we stack all the efficiencies possible and build flexibility into a plan in that case, as opposed to locking ourselves in with some type of irrevocable trust that might not make sense when they're in their 40s, which is 15 years from now.
Yeah, John, I've had the same argument with younger clients before, and one of the things I've noticed is that a lot of times, especially if we have a closely held business, depending on the ownership, right, we do make that play. We'll say, look, you've got liquidity over here. Let's not touch that. If we're going to gift anything now, we'll gift some of, you know, we'll recapitalize the company and we'll have non-voting units or non-voting shares, so that we can gift that maybe now to trust for the children. So if that company does sell or go public down the line and the big cash out happens, okay, you've got a pot of money that's going in there, but you're still going to have 75, 80, 90% of the ownership of the company so that you can, you know, that big cash out for the most part. I agree with you. $1 to $5 million. I mean, it's a lot of money, but at the same time, for the next 60 years, it's not a lot of money.
Yeah, exactly. And I think Alan followed up with, you know, but do you suggest taking capital gains now or rolling the dice, you know, for 20 to 30 years to see if rates will be the same or lower at some point? I don't think capital gains rates for young folks are, you know, I'm 28, you know, I don't think my capital gains rates are going to be that great going forward. I don't have a lot of faith in that. If you look at the deficit, if you look at some of the numbers, like, we got to pay for some of this stuff. So as much as I would like to think that capital gains rates are going to be low, I don't think they are. And so if I was talking to one of my younger clients that had high earnings, I would say paying tax 23.8% sounds like a decent deal. Let's take a look here. Scott asked, this might be a good one for you, Tim. If someone has an inherited IRA prior to 2020, dies, and the beneficiary is a child, the 10-year payout rule kicks in, correct?
That's correct. And that's, again, frankly, one of the frustrations here under Secure is this, it doesn't matter, right? So we even see this in the sort of the after 2020 world where, let's say we have an IRA that goes into, goes to a child who's under 18 and we can stretch it out, and something happens to that child and then it ends up going to another child who's under 18. It doesn't matter. We still have that 10-year payout. So essentially, once you get past the eligible designated beneficiary, even if the beneficiary of that inherited IRA is another EDB, it doesn't matter. It kicks into the 10-year, I say 10-year payout, but we have to remember too, there are no minimum distributions required in that 10-year window. You don't have to take anything out. So that's where, obviously, if we're talking about a Roth IRA, right, you're waiting until, day 9 or year 9, day 364 to take the money out. But if you have $1.5 million sitting in a regular taxable IRA, you're not going to want to do that and take it all out in 1 year. That's where, obviously, working with John, working with a professional advisor on this to figure out what the optimal way to take that out makes a lot of sense.
And Tim, it's funny because I think, I encourage folks to go back. So much has happened. Secure Act came in and it was the big news, and then COVID happened and the world kind of blew up. And I think a lot of folks, forget about some of the unique rules with it. What is an eligible designated beneficiary, and who are all these folks? Because I was actually talking to an attorney last week, and I was updating my estate planning documents, updating my stuff, and I'm a single guy. My beneficiaries are my parents, my siblings, and somebody was saying, we started talking 10-year rule, and I realized that I actually wouldn't be hit with the 10-year rule if something were to happen to me, because my parents are older than me, my siblings are less than 10 years younger than me, so anybody who would inherit an IRA from me that I've listed would get a stretch, and so that's a unique situation. But if you're going down a generation, that might not be the case. And so look at those different rules and identify, is this a 10-year rule situation, or does somebody qualify as an eligible designated beneficiary?
Yeah. And one point on that too, one of the benefits of Secure actually now is that we have for disabled individuals. So if we have an SNT, for example, Secure specifically says in a normal accumulation trust, for example, we would have to look and see who the remainder beneficiaries of that SNT would be, and we'd have to take the life expectancy of the oldest of those beneficiaries. But basically, Secure says once you get to the disabled person, you stop looking there and you take it out over the disabled person's life expectancy without the requirement, like in a conduit trust, where you actually have to pay out the RMD to that person. So it's really, that actually is a really nice benefit of Secure.
So you can accumulate in an SNT even over the stretch.
Right, which practically speaking makes all the sense in the world, because you would never want to have an SNT set up as a conduit, because you'd never force out the distributions to the disabled person, but most likely disqualify them from whatever benefits they were receiving in the first place. So, it's one of the rare examples where the change in the law actually makes sense, is logical, and is beneficial.
Any other questions? Last call.
Well, John and Tim, thank you very much for the presentation. We really appreciated that today. Just wanted to let you know that as speakers, we'll send you a gift card. I'd like to give it to you in person, but you'll have to get it by mail. And I want to remind all of our participants, not just to fill out the evaluation forms that'll pop up after we terminate this part of the webinar, but also to remind everyone about the networking afterwards. We're going to try something similar to what we did back in April, when it was just a pure networking event. So if you stay on, Karen at the EPC will make sure that everyone gets into separate chat rooms. Want to remind everyone here that there's a joint meeting with Monroe County Bar Association Trusted Estate Section. That's going to be on October 29th from 10 a.m. to noon. We had expected to be able to return to a hybrid meeting, but unfortunately it's going to be virtual. The Delta variant is still running rampant, so we decided that we'll just keep that program virtual for now. The topic is going to be diversity, equity, and inclusion in estate planning. And we have a local speaker, Karen Schaefer from Barclay Damon, as well as national speaker Kit McNay from the National Association of Estate Planners and Councils. Also, we want to remind everyone of the holiday program. If you want to mark your calendar, it's for December 2nd at 3:30. We're going to have it at the Genesee Valley Club, compliments of the Seneca Park Zoo Society, and hosted by longtime EPC member Ralph Buzz Code from Boylan Code LLP. Hopefully, we'll be able to make that as a hybrid meeting. That's what we've got it planned for now. But I guess we'll just continue to look for CDC and local health guidelines to determine whether or not we're going to go with a hybrid format for that one. But just wanted to thank everyone again. And keep in mind too that you received a networking link at the very beginning for the networking portion of the program, which is different than the codes are different than what we did to hop on the webinar. And again, thanks everyone for participating, and just watch for that pop-up window to come up for the evaluation form. And for the attorneys, make sure you fill out that attorney affirmation form, which is on the EPC website as well. Good afternoon, everyone, and hopefully we'll see you all at the networking sessions.
Thank you so much. And there is a speaker evaluation link in the chat box, as well as the Zoom networking link. So thank you very much, everyone. So check your chat box real quick.